So yesterday, literally yesterday, closed a transaction representing buyers that got the type of loan that hasn't been popular in quite a few years. I was actually kind of surprised by it, but thinking about it further, I thought it would be a really good topic for a video. What they ended up getting was an interest-only mortgage. So let's talk about it. The typical mortgage loan nowadays has a fully amortized loan payment. That means there are two parts to the loan payment. The first part is the interest, and the second part is the principal reduction. Now, the term for the typical principal reduction loan is 30 years. It's your basic 30-year fixed rate loan, although sometimes there are 20-year or 15-year or even 10-year loans that are available. An interest-only loan payment has one part. You just pay the interest that's due. So obviously, if there's no principal portion of the payment, it's just interest, it's a much lower monthly payment. And that's exactly why these guys made that decision. It was a lower monthly payment. And what's wrong with that? A lower monthly payment? How could you go wrong? Well, let's take a look at their specific situation and the numbers that they were looking at and see if we can come up with some of the thinking that caused them to make this decision and to see if it might be the right decision for you. So for them, it was a $750,000 mortgage loan that they were looking at. Now, on a 30-year fixed rate loan today, it's at 3.25%. That's a monthly payment of $3,264.05. Now, a 10-year interest-only mortgage, meaning it's an adjustable that's fixed for the first 10 years, but the payment is only based on the interest, is at 3.625%, which is $2,265.63 a month. That's a monthly payment difference of $998.43. So wait a second. They got a loan that was almost $1,000 a month less in monthly payment? What is there to think about, right? Well, actually, there are three specific things to think about before looking at an interest-only mortgage, and let's take a look at those three things. Number one is the interest rates themselves. So first of all, an interest-only loan is considered a non-conforming product. Whether you're getting a jumbo loan sized or a standard loan sized, they're not very popular. So an interest-only loan is always going to have a much higher rate of interest regardless of your credit score. So for these guys, on their $750,000 mortgage, that was over $2,800 a year more in interest that they'd be paying. So that's the first thing to think about. The second thing to think about is your loan balance. So obviously, if every single month a little bit of money goes to principal, that is going to have a lower balance over time. So I did the math, and on a $750,000 loan at 3.25% amortizing over 30 years, at the end of 5 years, you'll have paid off almost $82,000. All right? Now, the monthly payment was $1,000 less, meaning over 5 years, they would have saved $60,000. So interestingly, the folks that take the fully amortizing loan, $60,000 more in monthly payment ends up to be almost $82,000 in lower principal balance, meaning $22,000 over the course of those 5 years. Because what happens is on the fully amortizing loan, you make a payment, the balance goes down. You make a payment, the balance goes down. You make a payment, and the balance goes down. So the interest that accrues every month is based upon an ever decreasing, I had to think about that for a second, an ever decreasing mortgage loan balance. So more and more and more of your money goes to principal, and less and less and less goes to interest. On the interest-only loan, the mortgage balance stays the same, so the interest stays the same. So that's almost $21,000 more in equity on top of the $60,000 of equity. So mortgage loan balance over time is another thing that you have to think about. The third thing to consider are the loan qualifications. Interestingly, for the typical interest-only loan, the rate and payment at which you qualify is actually much higher than on a standard 30-year fixed rate loan. So there could be circumstances where somebody, using these same numbers, they could actually qualify and get it approved for a 3.25% $750,000 mortgage, but they actually wouldn't get qualified for the $1,000 a month lower monthly payment. So you got to think about the qualifications. They're actually tougher to get. So all in, what's the better way to go? If you're just focusing on monthly payment and nothing alone, it's obvious the interest-only loan is the better way to go. But soon as you add in the annual interest charges, the principal reduction over time, and whether or not you can even get that loan, the decision becomes far less clear. Generally speaking, if you're going to be in a house 2 or 3 years, no more than that, the interest-only loan might be the better way to go. But if you're going to be in a house 4, 5, 6 or longer years, absolutely no question about it, the 30-year fixed rate loan or a shorter term is the better way to go. Now, if you've got other mortgage questions, I'd be happy to answer them. You can contact me. Also, if you're interested in talking about selling your home or buying a home, I have a very specific system that I use for each of those scenarios as well. You can call me. My number is 949-413-2371. You can also email me, michael@hausamgroup.com. Thanks so much and have a great day.